Welcome back everyone. I hope you're having a great day. And in this video, we're going to take a look at a 3-fund passive stock market portfolio that can provide incredible long-term capital and dividend appreciation. This portfolio is designed to consistently build wealth over the long term and can be created by absolutely anyone. This is a passive form of investing. You do not need to follow the news, analyze any earnings reports or financial statements. All you do is contribute capital into this portfolio every week or every month. Then you can sit back and watch the power of compound interest take over and create immense wealth. The portfolio is designed to provide a diversified strategy, and the combination of 3 ETFs we're going to take a look at in this video gives you exposure to over 10,000 companies from all around the world. This is definitely not a new strategy. Financial professionals have been using this idea for decades, but I have made a slight change to the traditional 3-fund portfolio that I believe makes it more suitable for our current market environment. The traditional approach involves owning US stocks, US bonds, and international stocks. I have made a slight change to one of these selections in order to suit this portfolio to the current economic environment we are in right now. And before we can take a look at the first ETF that's part of this passive 3-fund portfolio, I'm going to ask you to please hit that like button and subscribe. I'm the Gen Z investor, and every single day we talk about the stock market, going over different stocks you can buy and any major market news. So please hit that like button, subscribe for the daily videos. And the first fund we're going to go over today is ticker VTI, which is Vanguard's total stock market ETF that currently trades for $219 per share. And this low-cost fund tracks the performance of the overall US stock market. So for a minimal expense ratio, you're getting exposure to thousands of American companies and get to track the broad market for a very low fee. And over the past year, it is up by 39%. And taking a look at Vanguard's website, we can see that VTI comes with a minimal expense ratio of only 0.03%, and this product offers exposure to large, mid, and small cap equities diversified across growth and value styles. And if we take a look, in total, there is 3,791 stocks within this portfolio. So if you're building out the 3-fund approach, VTI will commonly be the largest holding, making up anywhere between 60 and 80% of your entire portfolio based on your personal investing style. This is because historically, the US market has been one of the strongest performers in the entire world and averages between 8 to 10% annually pre-inflation over the long term. And we can see this is a very, very popular fund, and Vanguard has over $1.2 trillion of net assets held within VTI. The top 10 holdings of this ETF make up around 22.4% of the entire holdings, and it's broken down across every sector in the market. The largest, of course, is technology, followed by industrials, some healthcare, financials, and the remaining sectors make up some smaller portions. And taking a look at the top 10 holdings, we have names such as Microsoft, Apple, Google, Amazon, and Facebook rounding out the top 5, and the rest in the top 10 include Warren Buffett's company Berkshire Hathaway, JP Morgan Chase, Tesla, Johnson & Johnson, and United Health. So right away, the top 10 companies of this portfolio are very similar to the S&P 500, some of the strongest brands in the world that carry the large cap stocks higher and higher every year. So of course, owning exposure to the entire US market provides probably the simplest approach to investing. You don't need to pick individual companies. You don't know when it's a good time to buy or sell a specific brand. All you do is continuously buy the VTI index every single month without worry. And of course, that is the largest position for most investors within the 3-fund approach. And we can see that right now, this portfolio has performed incredibly well over the past decade. A $10,000 investment in VTI back in 2011 would have now grown to over $37,000, and it averages 14% expansion over the past decade each and every year. And since 2001, when the fund was created, so back 20 years from now, it's averaged 8.7% annual growth, which is absolutely remarkable. So this was the first fund to take a look at in a passive style of your investing portfolio, and for most people, this would make up between 60 and 80% of the entire weight. So now if we take a look at the second fund in the 3-fund approach, this is where I made the change from the traditional style. Usually the second fund relates to US bonds, but because in our current market environment, bond rates are extremely low And with current yields sitting right around 1%, I personally don't think it's worth it for young investors to be owning any bonds. Back when the three-fund approach was originally created, bonds were yielding anywhere between 2 and 4%. So it made sense to have an allocation of your portfolio into the stable bonds that provided some great income. But right now, the stability I don't believe is worth the minimal returns. And because inflation is on the rise, I think the underperformance of a bond ETF will actually hurt your overall performance over the long term if you choose to allocate anywhere from 10 to 30% of this three-fund approach into an ETF like that. So this is where I have made the change, and instead of a US bond ETF, I'm going with a US dividend equity ETF, ticker SCHD, which is Schwab's US Dividend Equity Fund that is up by 41% over the trailing 12 months. So although a dividend portfolio is still full of equities, so the stability won't be there like a bond ETF will be, but historically strong dividend-paying companies are less volatile than the overall market, and this fund currently yields 2.77%, but also provides long-term capital appreciation. So I think this may be a better switch than a traditional bond ETF because already you're getting more income every quarter, plus with the ability to see some greater capital appreciation. And if you're willing to take on a little bit more volatility, definitely a better approach than owning a US bond ETF in my personal opinion. So if we take a look at this fund, it seeks to track the performance of the strongest dividend-paying companies within the S&P 500, and it tracks the Jones Dividend 100 Index. So it provides exposure to different dividend-paying companies from various different sectors. And we can see there's over $25 billion of assets under management. The expense ratio is extremely tiny at only 0.06%, and there's a total of 104 different stocks within this portfolio. And we can see over the past 5 years, it's averaging 17% annual expansion. And since it was created, the average return is at greater than 15% per year. And it began back in 2011. So of course, it was created right before a major bull run in the market. So these returns may not be replicated over the long term. But to understand that owning some strong blue chip dividend paying companies that provide close to a 3% annual yield versus a 1% bond yield, I think trading the capital appreciation and the actual more volatility is better for a portfolio than the stability and slow growth of a bond ETF at this current point in time. That doesn't mean if we see bond rates increase going forward that it might be better to own bonds later in time, but right now, in my personal opinion, I would pass on a bond fund. And taking a look at the top holdings within this ETF, we see IBM, Home Depot, Pfizer, Pepsi, Texas Instruments, BlackRock, Broadcom, Coca-Cola, and all of the brands making up the top 10 holdings are large blue chip companies we all know and use on a regular basis. And if we take a look at the sector diversification, the largest sector is made up of technology, financials, consumer staples, and industrials. So you are getting some diversification within this ETF as well, and having some broad-based exposure to some of the strongest blue chip companies on the market. And we can see overall, dividend companies have performed very well, growing by 84% in share price appreciation over the past 5 years as well. And we can see from the crash in 2020, they have recovered very well. So overall, I think the second fund in a three-fund approach can actually be a Schwab US dividend ETF. I think it will provide greater income than a bond fund, although it does have a little bit more volatility. I think the benefit outweighs the cost, and switching of the bonds for some blue chip dividend paying companies may provide greater returns going forward. So that was my second ETF, and I would say anywhere between 10 to 30% allocation for this fund, once again, depending on your personal investing strategy. And then finally, we have some international exposure through a low-cost international ETF, and that goes by ticker VXUS, which is Vanguard's total international stock ETF that trades for around $65 per share and is up by 33% on the 1-year chart. And it does come with a nice yield right around 2%, and once again, a very minimal expense ratio of only 0.08% per year. And this ETF tracks the performance of the global all-cap ex-US index, meaning it tracks the investment return of stocks issued by companies located outside of the United States. So we got our domestic exposure through the first two ETFs in this portfolio. VTI is the total US market fund. Then we took a look at a US dividend fund, and now we're getting some broad-based diversified international exposure through VXUS. And if we take a look at the top holdings, there is 7,576 stocks within this portfolio. So in total, if you add up the 3 ETFs we're taking a look at, you're getting exposure to over 10,000 different companies by owning only 3 ETFs. So that's as diversified as you can possibly get. You're pretty much owning all the big, middle, and small cap companies from all the major stock markets all around the world. And pretty much, if you buy this approach, you're going to track the performance of the overall global economy and the overall growth of stock markets all around the world. And we can see there's over $405 billion of assets within this ETF. And the top 10 holdings include Taiwan Semi, Tencent, Samsung, Alibaba, and Nestle. And if we break down by portfolio allocation and where the funds are spread out all around the world, around 40% from Europe, 27% from the Pacific, 25% from emerging markets, and a small allocation to the Middle East, North America, and a little bit of other. So overall, you are getting some broad-based exposure to companies from all around the world. And why this fund is considered the third-based approach is because historically, the US market has outperformed on the global scale. And we can see this ETF overall has underperformed the other funds we've taken a look at. Since inception back in 2011, this averages around 5 to 6% annual growth. So although the entire US market is growing at around 12 to 15% per year during the past bull market, this fund is only growing by 5 to 6%. But of course, historical performance does not lead to future returns, and going forward, many analysts actually believe that the international markets will have a period of time where they outperform the US index. So I think having exposure to international stocks is a nice balancing for a portfolio and create more diversification for an investor who does not want to track any news and just wants to blindly buy and invest every single month. So overall, these are the 3 ETFs to take a look at for the 3-fund passive style of investing. VXUS for your international exposure, anywhere between 10 and 20% of the portfolio. Then we have SCHD, my personal twist to this approach, switching out the bond ETF for a US dividend paying fund. And then finally, we have ticker VTI, which I believe to be the most important and largest factor of this overall portfolio. Broad-based exposure to the entire US market that's historically performed very well, anywhere between 8 to 10% pre-inflation returns over the longer term period. So definitely a very nice investing style for all the people who do not want to build out their very own dividend portfolio. They don't want to take the time to analyze companies every quarter to decide when it's time to buy a stock, when it's time to sell it, and do all that work and all the headaches. And they don't want to risk underperforming the overall market. Buying a fund like this, building a portfolio as simple as this on any of the free services you can get into right now is definitely worth taking a look at. So thank you for watching this video to the end. Please hit that like button and subscribe. I'm the Gen Z Investor. We talk about the stock market every single day, and I will see you in tomorrow's video.